hedge funds are quite pessimistic about the US economic prospects because of this war. So let me give you some thoughts on why I believe the US economy is more resilient than that. Now, I'm not an economist, so consider this good enough for government work. Here are the 4 points in a nutshell why $100 oil doesn't break the US economy. And I'll go through each of these, but the point being, the US is a lot more resilient than many people realize.
The current macro backdrop is shaped by what Lee describes as a fog of war, a period of uncertainty where markets struggle to price in geopolitical risks. Oil prices have surged significantly, rising roughly 58%, while equities have declined, reflecting investor concern. At the same time, hedge funds are positioning defensively, shorting the stock market at levels comparable to major crisis periods like early 2020. This signals a broad expectation that rising energy costs and war will weaken economic growth. But Lee argues that this view overlooks several critical structural changes in the U.S. economy.
So let's talk about the macro. And the one macro thing I want to talk about is why the US can grow even with $100 oil. Now, I know we're in the midst of a fog of war, and the S&P is down 8% in February. And part of that has to do with the fact that oil is up 58%. Now, if you're pessimistic, you're not contrarian, because as you can see here, hedge funds have been shorting the stock market at the same pace they did in February 2020 and in April 2025. In other words, hedge funds are quite pessimistic about the US economic prospects because of this war. So let me give you some thoughts on why I believe the US economy is more resilient than that. Now, I'm not an economist, so consider this good enough for government work. Here are the 4 points in a nutshell why $100 oil doesn't break the US economy. And I'll go through each of these, but the point being, the US is a lot more resilient than many people realize. The first is that $100 oil today needs to be inflation adjusted. And when you do that, the oil price today is lower than it's been in the last 25 years. For instance, this is the nominal price of oil, what you pay at the pump or per barrel of oil. And at $106, it's near the peaks that we saw in 2008 and 2022, both times putting a lot of stress on the economy. But we have to remember, inflation reduces the present value of a dollar. And so when we inflation adjust crude prices, that's the lower chart here. And as you can see, the current price of oil is lower than it's been for most of the last 25 years. Again, that's good enough for government work. And here's another way to think of it. Think of the energy intensity needed to produce $1 of GDP. And as you can see, it's fallen sharply in the last 35 years. The second is that the war actually stimulates the economy. Firing bullets and ammunition is expenditures, and that boosts GDP growth. In fact, if you look at the last 7 major U.S. conflicts, the U.S. has spent $1 trillion inflation adjusted in many of these wars. Of course, World War II, but Vietnam War, the Afghanistan War, the war in Iraq. And so that leads to question, well, we've spent about $32 billion so far, but this could be $1 trillion of spending. On average, that works out to about $32 billion a month. So that's all adding to earnings growth right now. So the question is, how much would oil have to rise to offset that? Now, that's not a great comparison, by the way, because as I've explained before, the US is an exporter of oil. Therefore, rising oil is actually a boost to GDP. But let's ignore that for a moment. Here's a range of oil prices in gray. And then assuming 20 million barrels a day of consumption, how much does that increase the burden of oil to the economy? And as you can see, the higher the oil price, of course, the higher the monthly burden. But to match the wartime boost of 32 billion, WTI has to go to roughly 125. Now it could go there, but again, that would have to be a meaningful increase from the levels here. So again, good enough for government work. And then finally, keep in mind, stock markets are discounting mechanisms. And it turns out equity markets bottom very early in a war. In fact, over the 7 major conflicts I've highlighted, okay, the stock market bottoms within 10% of the duration of that war. I know that might surprise you, but take a look. This is the 7 major conflicts. But even World War I and World War II, the market bottomed within 5 to 8 months. And those were multiple 4-year conflicts. So bottom line, the US economy is resilient, but also it's a reminder not to try to time the market. And as far as how markets are being positioned, um, well, leading since the war started is energy. That's not a surprise, but notice crypto has outperformed gold meaningfully, especially Ethereum. And then tech and rate proxies have outperformed. So putting it all together, this is really basically what we've been recommending on the Fundstrat side, energy, crypto, tech, and rate proxies. So let's look at GRNI stock performance. The top 5 performers are energy and basic material stocks. Bottom 5 are hyperscalers and momentum names. Same thing with GRNY J. Top 5 performers are energy and basic materials, and the bottom 5 are basically AI and momentum related stocks. So on a thematic basis, the PMI recovery continues to perform well, and then energy and cybersecurity and easing financial conditions. So to me, this all points to the same notion that US relative growth is actually relatively resilient.
Perhaps the most important insight for investors is Lee's observation about market behavior during wars. Contrary to popular belief, stock markets do not wait for conflicts to end before recovering. Instead, they tend to bottom early, often within the first 10% of the war's duration. Historical data from major conflicts shows that markets typically reach their lowest point within just a few months, even when wars last several years. For example, during World War I and II, markets bottomed within 5 to 8 months. In more recent conflicts, similar early bottoms have been observed. This highlights a fundamental truth. Markets are forward-looking. By the time uncertainty is highest and headlines are most alarming, much of the negative impact is already priced in. Investors who wait for clarity often miss the recovery. Key takeaway: trying to time the market during geopolitical crises is extremely difficult and often counterproductive.
We've talked a lot about social interest, and it's one of the ways in which we use to talk about why Bitcoin dominance would go up, right? If you look at Bitcoin dominance for the last several years, you can see that it's been generally trending higher. And one of the reasons we thought that would happen was because of monetary policy, but because we were also looking at social interest and just seeing it generally trend down. And when that happens, Bitcoin normally takes over more and more market share. You might argue that Bitcoin dominance has been weaker recently, but I would encourage you to look at Bitcoin dominance excluding stablecoins, which is this, and you can see that the uptrend does in fact continue. So altcoins continue to bleed to Bitcoin. You can also look at the advanced decline index of the top 100 cryptocurrencies and see that it's been in a downtrend since 2021. And then finally, you can look at all Bitcoin pairs and see that's also been in a downtrend since 2021. So social interest in crypto has been generally dropping. And so because of that, we like to come up with a metric to kind of show us where is retail actually absent and where are they actually coming in mass. And so we've had the social risk metric for a long time, but it was developed many years ago. Now we have a lot more data. We were able to incorporate a little bit more data. We might tweak it a little bit, but for the most part, the social risk metric now looks like this orangish red line. The line that you see that's sort of grayed out is what it used to be. So that's what it used to be. And then now you have where we are right now. All right. I'll show you some of this stuff. So for Google Trends, for instance, we have this page here going all the way back to when Bitcoin was created, or almost all the way, 2010, obviously it came out in 2009. But what you'll see is the search interest on Google of just the term Bitcoin. What you'll see is that it actually topped in 2017 and then made a lower high in 2021 and even made a lower high in 2025. So it kind of shows you that interest has been fading specifically, but I think part of that was people got distracted with things that weren't as important. Because if you look at the social interest for, say, altcoin, you can see it had a major spike recently, and that's where a lot of people got drawn offside. But you could also argue that it spiked shortly, about 2 months or so before we had that major breakdown in October. You could also look at some of the other ones like cryptocurrency and see that's been kind of putting in some lower highs from one cycle to another. You can look at crypto and see that actually made a higher high from 2017 to 2021, and it nearly got back up to that high in 2025. But in terms of Bitcoin, it hasn't really looked that great for a while. But we do now include it in the social risk metric. If the business cycle, ITC business cycle chart, near the end of a business cycle, it's that speculative excess that leaves first. And then it kind of works its way down the risk curve until then stocks start taking hits. And then, Bitcoin took a hit. That's why you have altcoins bleeding to Bitcoin, Bitcoin bleeding to stocks, and stocks bleeding to gold, is because it's a late business cycle environment. We got a glimpse of this in 2019 as well, where social interest also more or less dried up. You can see in 2019, we also topped on apathy rather than euphoria. We did not see this metric go all the way up to the higher risk bands like it does at the end of the prior 4-year cycles. So it's all affected by monetary policy because, of course, crypto continues to be a lot of dubious speculation, as we call it. But all in all, I think the way the social risk metric looks now, you can see that it has been generally putting in, trending lower really since November of 2024. And the reason why that's interesting is because when you look at Bitcoin's valuation against, say, gold, it's been trending down since the end of 2024. And I know it had a little rally recently, but guess what? Doesn't mean a thing. So what? It had a rally in March 2022. It also had a rally in March 2018. Doesn't mean a thing. Still went lower. So just something to think about. The social interest helps us gauge why alt season did not happen, why there was not that rotation into higher risk assets. When interest is generally trending down, it doesn't make sense to call for major rotations from lower risk assets to higher risk assets. That rotation only typically occurs after you have euphoria in the lower risk assets that convince enough people that the top is in. Unfortunately, with a non-euphoric top, there were a lot of people that just simply weren't convinced the top was in, even though Bitcoin topped when it always does, and that's in Q4 of the post-halving year.
Putting it all together, Cowan's framework suggests Bitcoin will likely continue to gain dominance in low-interest environments. Altcoins may continue to underperform for extended periods. True alt season requires a return of retail euphoria, which we have not yet seen. This doesn't mean crypto is dead. It means we are in a different phase of the cycle, one that rewards patience, discipline, and macro awareness.